This episode is proudly sponsored by Netwealth. Launching nearly 20 years ago, this ASX-listed company is ranked number one for overall platform functionality and user satisfaction by investment trends for the past 3 years. As the financial advice landscape changes, it's important now more than ever to embrace new technology and enhance the way you do business. With this change comes your chance to innovate, explore new perspectives, and realize new efficiencies. Netwealth is here to support you on this journey by providing you market-leading technology, excellent customer support, and expertise to help you innovate in your business. Visit the Netwealth website to learn more and get the PDS which clients should read before making a decision. Products issued by Netwealth Investments Limited.
Allison Macfarlane.
Hi, Ray.
Thank you so much for coming down.
My pleasure. Good to be here.
I interrupted you as you were half telling a story because I wanted to start the podcast. You're saying you were talking in the office about podcasts.
I was, and I must admit I'm not a frequent user of podcasts, but with the popularity of XY and all the podcast downloads, I'm sure to become one. But no, in the media just this week about the murder mystery case up on the Northern Beaches being cracked open because of a podcast.
I haven't heard about it. So what happened?
Yeah, well, it's rather nasty. It's I think it's almost a 40-year-old murder case that's gone cold. But the husband is now being accused of murdering his wife and had an affair with a girl at the school that he was a teacher at. And the media have just come in and bulldozed his pool and all this sort of the house where they lived. And it's all due to this podcast, apparently.
Do you remember what it was called or what it is called? Yeah? No?
Teacher's Pet.
Okay,
Teacher's
cool.
Pet.
I know true crime's definitely becoming a thing. What got me massively into podcasts is something called Serial. And this was a series basically of an unsolved. It's a guy by the name of Anand, I think it was, and he's in prison, and this podcast producer took time to actually investigate it, and she sort of was recording as she interviewed him and researched the facts and dove into inconsistencies and really fascinating. And I think that kind of opened the bonnet for true crime. Yeah, my mum and my sister absolutely love it. They're always telling me to listen to stuff as well.
Cool.
And what's been happening otherwise?
Well, just getting out and about.
Winning awards?
In my spare time.
Yeah. What was the award that you won?
It was back in March. It was the Positive Progression of Women from the Financial Executive Women Association.
Okay, cool. And are they just financial services? Or
Yeah. So the association, or FEW as it's known, was formed around 5 years ago. Just had the 5th year anniversary with a round of conferences in March. And it's designed to sort of set up an advocacy program for women in financial services that are looking to learn from other women, both more senior than them, and then become an advocate for those younger, less experienced that are looking for guidance in their careers.
Is there a lot of younger women looking to get into finance as a career? Are you finding that that's sort of happening more and more?
Yeah, I think so. And coupled with the work I'm also doing with the Financial Planners Association, the FPA, they've now got a specific student engagement team that are working with students studying commerce or business and guiding them into careers in financial planning because, let's face it, there's going to be, a large gap in financial planning once the older planners, leave the industry over the next few years.
We obviously talk about this at XY quite a lot, but I sort of fast forward 10 years and I look at the average age of an advisor and, there's going to be a lot of books getting sold at a time where a lot of legacy revenue streams are going to be turned off at a time where wealth is probably going to change a generation. So it's kind of interesting to recruit people into financial services at the moment because I don't know that the industry is going to look anything like it does today when they've actually established in the industry. It's really exciting.
Yeah, it is an exciting time. It's I guess the world's the oyster for people that are of any age really that are prepared to grow and change and become more professional. over the next few years. So, I've always been a big advocate for financial planning as well. I've worked with advisors and alongside advisors for a long time now.
Yeah. So with Few, what's their presence like? Do they work with the likes of the FPA, or do they go to universities? What's their kind of?
Yeah. So Few was, as I said, set up 5 years ago, predominantly with the larger banks and institutions to help develop their people, to help them develop their careers and so on. And then in recent times, only in the last 12 months or so, they've formed a partnership with the FPA to build that out for financial planners. So for females within financial planning that want to work with a more experienced financial planner and vice versa. So that's starting to come through. And I guess my experience has sort of been a bit of an evolution. So around about early 2000s, I saw a bit of a gap. There was no formal groups like Financial Executive Women, there to support women trying to get to know each other and trying to build corporate relationships with each other. So myself and a colleague set this peer group up, and for around about 15 years we ran that with senior women in licensee positions, research roles, platform roles, and a couple of financial planners. And over time we would meet every quarter in a boardroom, and we'd have a professional agenda. And I guess the values that we held dear were around confidentiality, around professionalism, and around an open sharing culture. And this sort of thing has become more formalized, today in more of the work we're trying to do in the broader community.
So, and does that, because it's clearly women only, and does that come from the, I guess, way back when, or even today? I mean, I'm kind of talking out of school, but is there still a real kind of thing that women are dealing with in?
Yeah, it's a controversial and an interesting topic.
Yeah.
And you'll talk to probably me on a different day, and you might get a different answer.
You won't be held to anything you say.
Certainly, when around the turn of the century, making me sound very old, but around 2000 when this was started, it was very difficult. A lot of our colleagues in distribution, financial services were playing golf or going to the pub all afternoon. And, for many women, they simply either don't have the interest to do those sorts of activities or are unable to because of other commitments outside of work time. So, I think that there's that, but more recently, I think we're seeing a lot more of a balancing of particularly younger financial planners and financial services professionals coming through. That they go to university. A lot of them are 50-50 in commerce or business studies.
Gender split wise.
Yeah. And then you see that in the early time of being in the workforce or setting up their own businesses, etc. But something has happened, later on, around the time they're having children, starting a family, and I think that is still pretty much a real experience that people have today. Again, I'm being controversial, but not all people are affected by having family. A lot of professional women that I work with either don't or never will have a family, or not that way, or it doesn't affect their ability to do their job. Or it never should affect the ability. It's more around the commitment and the time that they can put in after hours and things like that.
It's look, to say something controversial, I've thought about it a bit, and for me, having a career, having children, and family life, it never needs to come at the cost of the other. But for women, clearly it's a different story because you're literally going to have a child, or that disrupts the flow. And I just wonder, because we do see pay inequality and those sorts of things, and clearly those stats are still happening. And I don't know the numbers in this, but I'd be really keen to learn, and I imagine there is still a bit of prejudice and those sorts of things that creates that. But I also wonder if you're, I don't know, a 25-year-old woman working in say financial services, you in a relationship, mid-20s, late 20s, have a baby, maybe take a couple of years out. and then start your priorities may then start to change, which means rather than happily doing a 7 a.m. till 7 p.m. job in the city, it's perhaps more, maybe I'll take the suburban role, still in financial services or whatever it is, but it's flexible working conditions and close to home and those sorts of things, which would clearly come at the cost of a higher salary. So I'm interested in understanding. I guess I'd be keen to see, how much of it is prejudice. I'd like to think that's dropping, and how much of it is circumstantial. Yeah,
I agree with you, Ray. I think it's more circumstances, and I would say there are equally as many men wanting flexibility and taking the home care role as women after they've had a family. So most definitely, I personally haven't really experienced any, derogatory attitude or missing out because of the fact that I am a working mother.
Even back in the 2000s?
No, not particularly. And I guess I'll emphasise the purpose of what I have done and what I believe is critical is just supporting people, whether they're man or woman, but just supporting each other in our career decisions, in sharing information, knowledge and what works, what doesn't work, and helping each other through. And I think that's the real passion that I have, rather than seeing it as a platform to, change gender biases or any of those things. Whilst I believe, that's important generally out there, and I would defend and be a feminist, but just on a day-to-day basis, for me, it's more around supporting other women with doing their role, doing it effectively, and whatever career tips and experiences that I can share to help others, then that's what we should all be looking out for each other.
Do younger, well, as women in this kind of community, as they do develop their careers, is it something that they're talking about in these forums to say, well, I would like to start having a family, but I'm worried about how that works with work?
Yeah, it's interesting. I mean, we at the peer group, the group that we very much stayed away from those sort of conversations. Okay. We wanted to be seen and known as a professional group of women,
right?
But it was more around giving each other the heads up about things and support. So from that respect, but at the FEW conference, not particularly this year's, but in previous years, we've always had a question from the floor. You have a panel of quite senior women in general management talking about their experiences, and it's natural for people that are going through, that very unsettling stage when they're just having a young family. They want to know how others have coped with it. So that is also useful, and I think, it's probably something more one-on-one people are happy to share. But everybody is so very different.
It's tough, isn't it? I mean, my heart starts to race when I talk about this stuff because I've got to be so careful, kind of a young male, and, I would have been seen as the problem.
Oh, no. It's good that we're having a conversation at all about it. I don't think there are that many conversations happening. So I think it's a good thing. And I think in financial services we're probably a lot better off than many other industries. We get very good pay levels, and we're professional. We have good education behind us. I think we're in a really fortunate position to many other people, women particularly, or young families around the place. But yeah, there's
again through my degree, I did spend a bit of time on this, and there's also this theory that way back when, as financial services was evolving, it used to be very ego driven. You used to be the stock picking guy, and you used to be able to pick the next best winner, and it used to be that kind of bang your fists on your chest and really kind of all that stuff. But as the industry evolves, if you actually look at the core of what advisors do, and you look at the conversations that the industries are having, there's a lot of maternal elements that are starting to come through. So it's actually nurturing clients, helping them understand their journey, and really facilitating people's lives. And I wonder if that then lends itself to being a bit more attractive for not just the ego-driven male, but then is that
interesting?
Yeah,
Haven't probably thought of it like that, but that's you, Ray. I like to have different aspects on it. I think the role of financial planning has changed a fair bit over the last 15, 20 years. I mean, the investment advice piece isn't so much the driving factor. It's more around understanding where the client is coming from, what they need, how to get them, to their goals. And you're right, the conversations are a lot more, on a personal level that, you want to get through a lot of those issues before you even start talking about money or products.
Yeah.
And so it's evolved to become more strategic and more around the client's perspective rather than them expecting the financial planner to have all the answers and have, just trust me, I'll get you there.
Yeah,
sort of thing.
yeah. Yeah, I'm smarter than the other
and we,
guy.
And I think that might be too why we have seen more women coming through. Definitely seeing more female financial planners, more so than ever in the last few years, which is a really good sign.
Yeah, I'm super keen to see what that looks like going forward. I'd like to think it'll start to even further represent the demographics of society. And I don't know. It's interesting to kind of think about. But it does scare me as a white male to talk about this stuff. Don't
be scared, Ray. It's okay.
But talking about strategy and those sorts of things, and because you work with a product provider as a I guess distribution, do you find that when you do speak with advisors now that they are focused on the product, or they're actually interested in how the product lends itself to strategy opportunities? And
most definitely the latter. Most definitely strategy led is the way. Even though I've been working on the on a tax structure product, the investment bond structure. That is all around strategy. But even now I'm also looking after the direct property. It's how to use that asset class in a portfolio and what does it do that other asset classes, that it's different from other asset classes. So it's more around the risks and the benefits of using that particular type of or style of fund.
Yeah.
And then more importantly, advisors want to know, who are the types of clients that are suitable for this.
Yeah.
So in the old days of talking about, managed funds, you'd go in there and you just talk about the shares in the portfolio and the returns and
that's all a managed fund is, right? It's shares.
That's right. That's right. And, obviously evolved a lot since then.
Yeah.
But no, it's what is it? What's relevant to the other person that you're speaking to? And in my case, it's advisors. In the advisor's case, it's the client. So that's why I'm always cognizant of explaining what are the benefits and the strategy that's going to help that client that you're talking to achieve a certain goal, whether it's nice income yield so that they can be comfortable in retirement, or they're having a long-term tax effective investment plan to save for their first property or send their kids to private school, something like that. So it's a lot for me. It's a lot more rewarding, and I'm finding I get a lot more engagement with advisors when then I can speak along the terms that they're thinking about as well.
When you say property, I know that it's a leading question. It's different to what most advisors would think of property being. Sending your client to a buyer's agent and buying something in Brisbane.
Yeah, sure. So Centuria is a professional manager of commercial property, or in our case, office, direct property. So actually buying sole buildings.
So office buildings.
And packaging them into a fixed term fund. With a set yield or an indicative yield, and going to market. We do 2 to 3 of those per year. And then ongoing, we have an open-ended diversified fund. So that's for people that are looking for exposure across many types of office buildings that's geographically split, that still has the monthly income, but it's also got a little bit of a liquidity facility as well.
Mm-hmm. Yeah, because I imagine liquidity is... these things don't sell overnight, right?
No. So you that's for your long-term or your self-managed super or your long-term part of the portfolio that, if there's a liquidity event, you don't need to necessarily get out and sell it all at once. But if you're in the right fund that's being managed properly with good tenants, low vacancy rates, long WALE or weighted average lease expiry. I'm learning all the techno jargon now.
Yeah. All the acronyms.
Then you've got a better chance of getting that boring, stable income coming through every month.
Yeah. So how does it work? Because is it literally going to finding or developing a building and then literally saying, okay, we'll wrap that up into a fund, and then we're split into 100 units, and the building's worth $100. So we then.
Yeah, so we don't tend to develop, as in buy an empty or a building that we knock down and rebuild. It's more acquiring something that's already standing.
Okay.
And then we have an acquisitions team that will go in and typically these days buy off market, which is important to look at because there's a whole lot of investors now. There's 20 or so buyers swarming the market every time a building comes up for sale. It's quite a tight held market.
Why is that?
Yeah, just property prices. I mean, it's valuations. We've had the Sydney Metro project in Sydney take out 17 buildings around the CBD. So there's limited supply. Although we've had Barangaroo come on.
Yeah, it's kind of different clients though, isn't it? Because I'm led to believe Barangaroo is more big places, and you've basically got a whole bunch of not smaller, but maybe 50 to 100 headcount.
Yeah.
Firms that are like, well, we can't go to Barangaroo.
Exactly.
Yeah.
Exactly. So we're sort of seeing, very low vacancy rates, very high rental yields coming in now. So it's very difficult to find good value in the Sydney and Melbourne CBD. So to have relationships with other holders of property and to be able to transact off market is quite an advantage. And then we also have, in addition to the acquisitions team, a leasing and tenancy team. So it's all about, getting the most out of your tenants and building, making sure the lifts are working, that the office, the building's in good repair, that you can then negotiate longer leases. And they'd be happy, and get forewarning when they're planning to leave, well ahead of the contract and those sorts of things. So, and then the final step that we add value is in the refurb. So being able to completely, renovate a building to add value to it as well, just like you would a residential investment property. Yeah. So those three things are important. Sticking to what like sticking in your area of specialisation, which for us is office. We have something like $4 billion between.
Yeah, it's big, isn't it?
Yeah, between two listed REITs. Oh, actually, one of the listed REITs is an industrial fund. That's $1 billion. $1 billion in the CMA, the Metropolitan Office, and then $2 billion in unlisted. So that's across about 15 single asset funds.
Mm-hmm. And unlisted for wholesale investors?
No, these are for retail investors. Yeah. Okay. So we do. We offer both. We'll have basically a closed end period of time to raise capital.
Right. So that means
between $50 and $1 million, and we'll go to market with our direct investors and advisors that have those types of investors.
Yep. And
make the offer, and then we close it out within. The last two we've done this year have closed out within 2 weeks.
Wow.
So there's a lot of demand, a lot of pent-up demand for this type of asset.
Yeah.
Because the type of investor that's going in there, they tend to be they're quite sophisticated.
Yeah.
They're quite averse, and they like the higher yield. The yields are around about 7% that we've done on those two properties this year.
Yeah, wow. So is there a particular type of advisor that gets attracted to this sort of stuff? I'm just sort of thinking because this is sort of a unique opportunity to learn about, because I a lot of the advisors that I know are in XY are, relatively traditional in the understanding of managed funds and ETFs and those sorts of things. And this is maybe something that's a bit outside.
Yeah, it's specialist. It's definitely a specialised area. The average super fund, the APRA fund, would have 10% to direct property or to property, and about 7% of that's listed. Mm-hmm. So we're talking about, around about 3 to 5% of a portfolio. We're not sort of suggesting that it should be, a major part, but for some people that are comfortable with it, it's a good alternative to shares. It's low correlated to the share market, a bit more stable in valuations, only because they're not marked to market every day. But yeah, we also have the diversified property fund, which is a managed fund, and it sits on platforms, and it's more of a traditional style fund. It only has a monthly liquidity rate, but it still offers that open-ended, allocation. It's got a LonSec recommended rating. So we're working with licensees at the moment to have a look at that, where they are interested in having a direct property allocation in the portfolio.
Right, and then is there any complexities that advisors need to think about, I guess, from a licensee perspective? Is there any sort of quirks?
Look, it's like any asset class. Know your product. There's things about property that that you want to get your head around, like what the yields mean. That there is tax effectiveness in terms of the income that's payable. So tax deferred income. So it's not just shares that pay tax effective income. The risks of liquidity we've talked about, gearing. How that all interacts, and the quality of the buildings, and how the managers and obviously a research house like LonSec is all over that and can be used for for a reference point for advisors.
Yeah, interesting. I got to be honest. I'm not so familiar with the world of unlisted property, but my sense is I do work with a couple of wholesale clients, and I know that often if you're just doing the bread and butter basics from an investment perspective, often there is a little bit of something that you need to do, or there is a demand for something that's a little bit different.
Yep.
If for no other reason than the narrative or a bit of sizzle, so long as I guess that's done in the context of the overall.
Yeah, if they understand, that to get a 7% yield when term deposits, are paying 2.38%,
basically inflation.
So there's a risk to that, and with all reward comes those, and then to understand how that's managed. If it's not a big part of the portfolio, then it's not such a big deal, and other ways that can be mitigated. So it's just I think I'd always say to advisors, just invest what you're comfortable with, and what you and work with us if you want to know more. We're here to help, and you've got good research coming out as well. So
awesome. So. From bonds to property, what were you doing before bonds? I actually don't know the answer to this question.
Well, I worked as a national key account manager for Perpetual.
Okay.
So I worked with the large aligned groups that were the key clients back then, such as Commonwealth Bank, IWF, ING, Groups, Count, which was separate to CBA back then.
That was the merger with their accounting.
That's right. Count became listed, and then it was acquired by Commonwealth Bank. Different roles throughout the time. I've worked for a startup as well back in when was this? Around about early 2000s. I did a startup distribution company that did third-party distribution for brands that weren't familiar in Australia, such as Lazard and Aberdeen and Hyperion, which of course are now household names today.
Wow. Okay. And what was that like working at a startup?
It was fun. Yeah, I really enjoyed it. Not only that, but it was an all-female team.
Nice.
So we had a lot of fun.
Was it in Sydney?
Yeah, it was in Sydney.
When was this?
2004 to 2008.
Okay.
And it was really,
What a period.
Yeah, it was good fun. And we raised some really good money for our clients there, and had fun along the way. So there's always different things to do in this profession. I think it's really rewarding.
Is there a particular sort of space that really gets you excited about where the financial world is looking at tomorrow? I mean, for us, we technology is the well beaten drum. I think a lot of us now are looking at education and those sorts of things.
Yep.
I've probably got a few views on that. And then clearly we've got the RC going on in the background, and that's stirring the pot and asking some interesting questions. So I mean,
definitely.
Have you sort of got a view on what our tomorrow looks like, and we can crystal ball and
oh wow, I love doing that. That's good fun. Well, I think the Royal Commission has. Look, it's talked about things that I think it's fair to say most people in the industry are well aware of.
Yeah.
It's more just making the public aware now. And I think that, we're going to see more professionalism, and I mean, who knows what will happen with the large institutions owning advice?
Yeah.
We've already seen, Commonwealth Bank plan to divest.
To divest of their
of financial planning.
Really?
Yeah. So
Okay.
they're going to go into another entity.
Yep.
And also,
Is that CFS?
Yes,
Yep.
CFS.
Yeah.
That's right. And the same is happening within. BT has not made any major announcements,
Right.
as yet. But
in terms of extracting themselves out of Westpac.
Yeah.
Okay.
But it's very interesting that I think that, and also even down to the I read this week around the managed discretionary accounts section with the Sam Henderson case and the model there of internal vertically integrated models. So I think it's all up for grabs. There's that. There's also the grandfathering of the Trail Commission issue, which could very much impact the valuations of the books of businesses that might be sold by the older planners exiting because of the education requirements.
Yeah, I wonder if there's some decent deals to get done at the moment if you're looking to expand your business, right? If you're a retiring advisor, you'd be pretty nervous, I imagine.
Yeah, I think so. Because the reason why they're on such high multiples, they're on multiples. An accounting firm is on a multiple of just under 1 times revenue. These days, the multiple are around about 2.5 times. And the reason for that is because advisors are getting that recurring income through the Trail Commission.
Yep.
Or they're on a platform and they've got it all coming through. So if you sort of take away a chunk of that, many of the fee-for-service models at quality advice firms are not so much reliant on those old Trail Commissions these days. It was a while ago now, but the ones that have built a large book that are sitting on that recurring revenue could be at threat.
Yeah.
Or at least that portion could be. But we're also seeing a lot of smaller licensees coming out, a lot of change coming through. We had the Dover breakup, and we have several other larger groups also under suspicion and investigation by ASIC at the moment as well.
Yeah.
So we're seeing the just proliferation of smaller licenses banding together at this stage. But we may even go to individually licensed
licensed advisory firms. Yeah, I did a study tour in the US in 2014, and I looked at the way that their world works. So in Australia, we've got an inherent fiduciary obligation to our clients, which all advisors in Australia would be very familiar with, but it's not necessarily the case in the US. If you're a US advisor and you work in what they call a wirehouse, so like a stockbroker, you don't have a fiduciary obligation, and what that means is that if a client comes to see you and says, "Look, I've got a bunch of money that I would like invested. Can you please do it?" There's no obligation or perception that you will go to market and understand the various options. It's more that you have a solution in-house, and that client is coming to you and is expecting that in-house solution.
Yeah.
As opposed, but they still do have the what they call RIAs, where it's like us or every other advisor in Australia, where you've got that obligation to go around. And I just wonder if this conversation in Australia starts to get a little noisy. So if you're an AMP advisor and somebody comes to you at AMP, I just wonder if there would be. Well, I feel like there is the expectation on the client to some extent that you would be providing AMP advice, and to say, oh no, CBA is actually the one that I researched, and I wonder where that sits, because and it's a sort of a long-winded way of sort of thinking about it, but I wonder if there is space for the non-fiduciary component to be in Australia to say, look, this is the things that we believe in and these are the things that we do. It doesn't suit everybody, but and I guess it's around being really clear around that. Yeah.
I mean, there's a lot of distinction. Well, looking at the difference between general advice and personal advice. But I think you were referring to personal advice from one institution.
Yeah. So
and that's how it used. That's pretty much how it used to be.
Yeah.
And I don't think that there's anything wrong with that. I think where it has broken down is that we have tried to give, the consumer all this choice, and the advisor wants to be able to give them all different products and sitting on different platforms and things. But there's been so much compliance around how you disclose the conflicts or disclose it that the document, this SOA, just becomes this long-winded thing that the client ends up finding difficult to understand and appreciate. And then it's not so clear then, what is actually, in the interests of the advisor rather than the client. It's not always clear. And I think that's what this whole best interest. I mean, I couldn't believe I went to a roadshow in July for the FPA, and there was half an hour spent on best interests. And I thought, hang on, this all came out 5 years ago when we had FOFA. I'm surprised that we're having to go through this, and it's I guess it's because it's not been followed or interpreted correctly. And that's, is that our fault as an industry, or, do we need more guidelines, or has this, really been tested before now? I don't know, but
or is it maybe the case where if you are an aligned advisor, but it's not clear how you're aligned, then the client's been deceived. So maybe that's kind of what it's picking up. But and the reason I was sort of wanting to stay on that is with the colonial first state thing is, if you're a colonial first state advisor and you have an obligation to go to market, then in terms of where the products or what products you recommend, that's fine. But clearly that's going to increase the cost to serve. However, if you're a colonial first state advisor and you say, all I'm going to ever recommend is colonial first state, and it's not appropriate for everyone, but I can let you know the pros and cons relative to you, I would suggest that would lend itself to a lower cost model. And so long as it's clear, I don't know that I don't know if this is I don't know that there is, or I don't understand if there is.
No.
Yeah.
No, I don't think so. It's just that although in best interests duty, whether you could say, you'd have to still know where the client was coming from. And whether this product that you're recommending is better.
Clearly you need to tell them the pros and cons. Like if you're a retiree and all I do is invest in startups, I need to tell you that you don't look like a lot of my normal clients. And I'm not necessarily saying but like, just be clear that you're the startup guy. You know what I mean?
Yeah. That's right. And it's knowing those right questions, I guess, to ask and define it. And I think the traditional way of risk profiling that advisors have followed has been around, whether they're a balance to growth or and, does that necessarily give you, as the advisor, the right direction? And are they understanding what risk actually is? So there's another area.
Super tough. I heard a story where a client had a small portfolio. I think it was like 25 grand, retiree in her 80s. I can't remember what product, but it was one of the larger ones. And she'd called an advisor and said, "Hey, I've not heard from anyone for a while. It's fine, but I'm just keen to make sure that there's nothing wrong with what I'm going on in place. I've got a statement, so I thought I'd jump on the phone." And then the advisor had a look, and it turned out that the portfolio was 100% Aussie equities. And she's drawing an income. So clearly there's a conversation to be had. However, and the conversation was had to say that, you're in shares, and often clients look at and say, all right, well, how do we go about this? And the advisor needed to send a full fact find document, a full risk profiling survey, all the file notes. And clearly, unless the business copped the cost of that work, would need to also ask the client to write a check, which makes me really upset, because you've got an 80-year-old lady who just wants to know whether or not she's done the right thing. There's no revenue opportunity or no motive in terms of what the advisor is wanting to do beyond answering a simple question. But the regulatory framework requires, 1, 2, 3, 4, 5, 6, 7 steps. And I just don't know that it's conducive with growing that 20% of Australians who get advice to...
I agree with you, Ray. I totally agree. I don't have the answer.
Come on.
I wish I had all the answers. Come on. But yeah, I think that, and I think that that's what would attract more and more planners as well. If they could see that, because I'm hearing it every day, just the burden of all of the compliance and the work and the time and the SOA production and then how much it actually costs to then say to a client, you really need to be paying me, hundreds or thousands of dollars for this one piece of advice.
Yeah.
If it's worth all that time I take. And yeah, there needs to be a better way.
Something in between. And that's why I keep going back to that US. It's like, if I clearly represent a product suite or a solution, does that fiduciary obligation create a barrier? And it feels simple, and I just don't know what I'm missing.
Yeah.
So maybe something we can talk about for the part B when we get in here in a few weeks.
Definitely. That sounds great.
Cool. Well, I really appreciate it, Allison. Thank you so much for taking the time. And for anyone who wants to get in contact with you or chat to you a little further, is there a way for them to best do it?
Yes. Yeah. I'm on LinkedIn. Yeah. Is that a good way?
Yep. Allison Macfarlane.
And I also wanted to put in a plug too. There's a Women in Wealth breakfast for the FPA Sydney chapter on Wednesday the 17th of October. Guest speakers Dr. Jill Hicks. She was the lady that was in the London bombing and became an amputee a few years ago, the terrorist attack.
Yes. Yeah,
Very inspirational woman. That's a breakfast. And also financial executive women had a few circle. A circle is where they can get together and actually discuss issues and questions as a group. Actually, it was on yesterday in Brisbane. So sorry, Brisbane. But
but I feel like that might be something that people are interested in. So Few is the female executive.
Yeah, financial executive women.
Yep.
Jump online and check them out. You can join. There's a discount for FPA members. And we'd love to see as many planners get on board with that. And, and the men are welcome to our events as well, Ray.
Oh, so it's not just women?
No, we don't, we don't just, discriminate. But thank you so much.
No, not at all. And for people who are listening and keen to catch up with Allison, she's far from scary. But, otherwise, pop a couple of notes in Facebook. I'm sure Allison will happily get back to you. But thanks so much. Have a lovely weekend and really appreciate it.
Thank you.
Thanks.